So we're finally in the section about trading strategies. And the first trading strategy we're going to look at is market making. Now, market making might not be the strategy for you. It might be, but it's a very important strategy to learn. So regardless if you think you want to trade the strategy or not, I highly recommend listening to this section or these few lectures here on the strategy completely. Okay, so I have a lot of things to say about this strategy. And so what I'll do is we'll explain what the strategy is, and then I'll give my comments about it. So what is market making? Market making is basically, or the definition here off of Wikipedia, is going to be that a market maker or liquidity provider is a company or an individual that quotes both a buy and a sell price in a financial instrument or commodity held in inventory, hoping to make a profit on the bid-offer spread or return. So what does that mean? Well, it means this. It's just somebody who goes on the market, who looks at the order book. Imagine you have a order book, okay? A order book. Okay? And on this order book, you have all your buyers here. So let's say somebody wants to buy at, I don't know, $10. Somebody wants to buy at $9, $8, $7, $6. And then on top of that, you have all your sellers. And you have a seller at $11, $12, $13, $14. And there's the quantity, right? Maybe, 10 coins, 1,000 coins, whatever the quantities are. Doesn't matter for now. What a market maker is going to do, he's going to go and try to buy here at $10. He's going to place an order. And he's going, to go in the queue. So if there was 100 coins in front of him, he's going to place an order and he's going to go behind these 100 people who want to buy at $10. Or the quantity 100. So he'll go in the queue. Once they're all filled, it's going to be his turn to get filled. So what he's hoping for is for somebody to sell to him, right? And when he buys at $10, what he's going to do, he's going to go and place an order at 11 to try and sell at $11. And he's hoping that a buyer is going to come in and buy from him. So this is why they're called market makers, because they're creating a market. Because imagine this, imagine you go on this stock. Let's call this stock XYZ. Okay, you're going on this stock. You want to buy it. You want to buy it right now. So you go and you place an order to buy it from one of these sellers. You want to buy, or you send a market order. So you buy from one of these guys. Now, since there is a market maker, you are able to buy because he's there, right? And thus he's creating a market for this product. Because if he wasn't there, maybe there wouldn't be a seller here, right? And it's the same thing if you want to sell. Let's say you come in and you just want to sell it right now. Well, let's say there's a market maker at $10. You sell it to him right away. So he created a market. Basically, a market maker is like a middleman. He's there, he's willing to buy at low prices. So if a seller comes in, the seller can sell to him. And then he's going to try and turn around and sell it at a higher price. And if a buyer comes in and wants to buy right away, he'll be there to sell to him. So he's kind of like a middleman, and he's offering liquidity to people who want to buy and sell. Because on every transaction that occurs, you have two parties. You have one party that's an aggressive party and one that's a passive party. So if you place an order and your order goes on the order book, right? Your order goes on, let's say, at $10. And you want to buy at 10. You place an order here, you're a passive buyer. Now, if you bought at $11, you're an aggressive buyer because you're buying off somebody who was already there. If you were a seller, on the other hand, and you're selling at $11, then you're a passive seller because you're passively sending an order and waiting to get filled. The price might drop and you might never get filled, but you're placing an order and hoping that somebody buys from you there. Now, if you want to sell right away and you sell at $10 where there's already a buyer, you're an aggressive seller. So the way it works is when a order is resting on the order book because you sent it and there was nobody there for you to transact with, you're a passive person. And when you're selling or buying from somebody who was already on the order book, so you're getting instantly filled, you're an aggressive participant in the market. And another word for this is we often say these people who are on the order book, they are adding liquidity to the market, adding liquidity. And if somebody is being aggressive, so if you're selling to somebody who's already on the order book or buying from somebody who's already on the order book, you are removing liquidity, right? Now, exchanges, they want to have market makers, right? Why? Because if there's no market, people might not want to trade these products, right? And let's say imagine there was nobody on the order book on, let's say, Bittrex, one of the exchanges. Would you want to go trade on Bittrex? No. Or on Binance? No. So these exchanges want there to be market makers, okay? And this is why they will offer, let's say, for example, I'm going to try and search for Binance fees. They're going to offer incentive for you to be a passive participant in the market. So if I go here on Binance and I check their fees, they'll tell you that the fees here, this is based on how much you are trading, right? And they'll have that the fees if you are a maker versus a taker. So there are different fees for if somebody is adding liquidity. So a maker, you're making a market, or taking from the market. And you'll see that the fees here, and it'll change based on the volume. The more volume you make, the better the fees will be. Maker could be twice as less than taker fees, right? And actually in the stock market, sometimes if you are making a market, if you're adding liquidity, they actually pay you. They take some of the fees that the person removing liquidity is going to be paying and giving a part to the person who's making liquidity. That's how much of an importance market makers are, because they create a market for this product. Now, market making is such an important thing in the financial markets that in the stock markets, you could register and be a market maker for a specific stock, and you would get a lot of benefits. And market makers in the stock market in the 80s were the richest and most successful people in the markets. They would make way more money than, let's say, portfolio managers or hedge fund managers. They were making a killing, okay? That's in the 80s. And why? Because the spreads back then were huge, right? Because a market maker, how does he make his money? He buys at the bid and he tries to sell at the ask. So he makes the spread. Nowadays, the spread, and let's talk about stocks just for a second. Nowadays, the spreads on on most stocks is like a cent. You buy on the bid, you sell at the ask, you make a cent times the amount of shares you have. It's not a lot. But back in the days, the spreads were very huge. They were very large. And before, on the stock market, we weren't even trading at cents. We were trading on 1/8. So the spreads were big. But that changed with time, because the markets became more liquid, more people were trading, the spreads got tighter. We had automation, so computer softwares would basically come in and buy and sell and reproduce those types of strategies. Now, the funny thing is, in the cryptocurrency market now, we have things that that worked for market maker for stocks way long ago, because you have to understand that the cryptocurrency world, the cryptocurrency markets are not as advanced, or they're not like where the stock market is right now. So things that we saw in the stock market 10, 15 years ago, we're seeing in the cryptocurrency market right now. So things that are very hard to do now in the stock market are not as hard to do in the cryptocurrency market. Okay. And another one of the reasons why I really think that this is an important strategy to understand how to do is because the first time I ever traded, professionally, it was at a company called World Trade Securities. I actually have a picture of it here on my Facebook. So this is the first proprietary trading firm that I worked at, and this is the only picture I found. I found a few of them on my Facebook here. This one I posted on my Facebook in 2012. I started working there in 2011. So yeah, that's a long time ago. And this was the first professional trading job that I had. Because before that, I was just trading by myself. I started, cold calling all these companies. I was able to get an interview with one. I convinced them to let me work there, even though I had barely started. I don't know if I started university by then, probably, yeah. But, I was still very young. And they took me in, And this company, the only thing that they did was market making. They only did market making. So the floor, you can't see here, but the floor was 2 floors. On the first floor, this is where I was. We had 4 rows of traders. So across the whole floor, maybe we were between 40 and 50 guys. And everybody was doing market making. They did not permit you to do any other strategy than market making, because this was the way they were making money. That was the strategy for this firm. Okay. And I've done that pure market making for a period of, I don't know, 8 months to a year. I worked at this company. And so they were basically trying to buy at the bid, sell at the ask. Now, when I worked there, at that time, there was a lot of automation already that's being done. So people there who were making millions of dollars before were making way less money because it was just way more competitive at that time. But they were still making money. And the way they did it is, as a trader, you got a desk, you got your level 2s for each stock that you were trading. So you'd see a level 2 for each stock. You would have the chart, and then you would place buy and sell orders and try and buy and sell. And you would start off with a very small amount of money. So you just buy 100 shares and sell them. And you're making 1 cent. So that's $1 per trade. And if you're able to be profitable for a week, if they see that you're good, they size you up. So then you have 300 shares, 500, 1,000, 10,000, 50,000, 100,000. So at one point, you're trading with 100,000 shares, and you're trading very cheap stocks because they were only trading stocks at this time. Nobody was really trading cryptos back then. So basically, we were trading very cheap stocks like Bank of America, SiriusXM, CIM, like these very cheap stocks that are trading at $1, $2, and you're buying 100,000 shares on the bid, and there's 1 cent spread, and you're selling the $100,000, the 100,000 shares, 1 cent higher. And if you make that money, well, you're making $1,000. Now, if you buy on the bid and you see that the price is going to drop, we would sell it back at the same price we bought it at, taking 0 loss, but paying a bit of fees. Now, if it drops 1 cent, we would try to sell it back on the ask, which would be a flat trade. Or if it's going to drop again, we sell it and we take 1 cent loss, which would be $1,000 loss. And you just continuously buy and sell, buy and sell. Now, they were making good money because we had hotkeys to do these things quickly. So I had on my keyboard 48 hotkeys. I want to buy at this price, sell at this price. And as you really did this every day, you got really quick. And that was what this company was doing. And that's, I'm grateful for this, because having market make for such a long time, it gave me a very strong understanding of reading the order book, understanding order flow, being to, catch if there's a big buyer or big seller coming in, and trying to predict what impact he's going to have on the price, monitoring news, a bunch of these things, because it's such a basic strategy. There's not a lot going on. You're not looking at a lot of statistics. You're just looking at the order book. And I'm grateful for that, because it gave me a very strong foundation. So this is why oftentimes, even if you're trading an advanced strategy, it's good to test something like this, just to see how the basics and the microstructure of the company works. Now, this company was called World Trade Securities, WTS. I left them because I wanted to do other strategies, automated strategies and whatnot, and they did not permit it. And, after I left, just a bit after, they actually shut down. So I don't recommend doing market making in the stock market, because in the stock market now, it's so automated. And as well, you don't have a lot of, you don't have the same things that we have in cryptos right now. Like, it used to work really good in the past, but things have changed. Things are way quicker. There's a lot of HFTs that are doing these things. In cryptocurrencies, you're going to see in the next few lectures that there are some of these coins that look way better than even the stocks that we were trading back then for stocks. So yeah, even though I don't recommend doing it for stocks, for crypto, I think there's a big place there. So yeah, they actually ended up shutting down. I think they might have another office in New York. Not too sure if that's open or not, but yeah. So market making. Who is it for? So market making is going to be for somebody who has a lot of time to put in front of his screen, because you're going to have to be in front of your screen and be, ready to click. Okay. So you have to have the time. Also, this is something you can do manually, right? Also, if you have experience in or knowledge in programming and you can automate this, this is a highly automatable strategy. You can automate it and leave it running 24/7. If you don't know how to automate strategies, check out my other course on cryptocurrency algorithmic trading. Click on my name and you'll find it somewhere there. But yeah, automating the strategy could be very helpful. If you are doing anything long term, then you don't want to look at the strategy too much. But you can test it out for a few days just to get some knowledge and learn about it. I think it's very interesting. So yeah, I think this is enough for this lecture. Let's move on to the next lecture and keep developing on top of what we're saying here.